What if I told you that on the very first day of your retirement, an invisible clock starts ticking? And if you don't act quickly, HMRC could quietly take thousands of pounds from you without ever sending a warning. And the worst part is, most people never even realize it's happening until the money is already gone. Now, before we go any further, if you're anywhere near retirement or you love someone who is, do this right now. Tap that like button, hit subscribe, and share this video with just one friend who worked hard their whole life. Because what I'm about to tell you could genuinely be the difference between a peaceful retirement and years of quiet financial regret. This isn't dramatic, it's just true. So let's begin. Let me start with a story about a woman I'll call Margaret. Margaret worked for over 40 years. She was a school administrator, careful with money, the kind of person who kept every receipt in a shoebox and read her bank statements from top to bottom. She retired at 66, feeling proud. She had a small workplace pension, a private pension pot she'd been quietly building on the side, and her state pension coming through soon. On paper, she had done everything right. A few weeks after her last day at work, she decided to take £15,000 out of her private pension. Her plan was simple. She wanted to help her son with a house deposit, take her sister on a proper holiday, and finally replace the boiler that had been groaning for years. She knew a quarter of the withdrawal would come out tax-free. She had even done the maths on the rest. She expected to pay a reasonable amount of tax and move on, but when the money hit her account, her stomach dropped. Thousands of pounds were missing. Not hundreds. Thousands. She sat at her table staring at the number, wondering if she had made some terrible mistake. She hadn't. The system had. And nobody, not her pension company, not HMRC, not one single person had warned her. That's the problem I want to fix today. Right now, for you, here's the truth that nobody ever explains properly. When you were working, tax was something that happened quietly in the background. Your employer took it off your pay before the money ever reached you. You never had to think about it. You didn't have to fill in forms. You didn't have to check codes. You didn't have to chase anyone. The system just ran and you got on with your life. Then the moment you retire, something strange happens. That entire system switches off. No letter arrives to explain the change. No advisor rings to guide you. No official checklist is handed to you at your leaving party. You go from a world where everything was done for you to a world where every single tax decision is yours, and every wrong move can quietly cost you real money. That is the trap. And it's not because HMRC is cruel, it's because the system was never designed to hold your hand. It was designed to collect. And if you don't know the rules still apply to you anyway. So today, I'm going to walk you through the 10 things HMRC quietly expects you to understand the moment your working life ends. Some of these will save you thousands. Some will protect the money you already have. Some will just make your life easier, but every single one of them matters. And the first one I'm about to tell you is the exact same one that hit Margaret. It hits tens of thousands of newly retired people every year, and almost none of them see it coming. So stay with me, because this list is the one nobody ever gave you, and it might be the most valuable few minutes you spend this whole year. Let's start with the first one, and it's the biggest. When you take your very first taxable withdrawal from a pension, your pension provider often does not have the correct tax code for you yet. HMRC hasn't updated their records. The provider isn't allowed to guess, so they use something called an emergency tax code, applied on a month-one basis. Now here's where it gets ridiculous. The system treats that single withdrawal as if you're going to take that exact same amount every month. So if you take £15,000 in one go, the system pretends you're earning £15,000 every month, which would make your yearly income look like £180,000. That pushes big chunks of your money straight into the 40% tax band, and sometimes even the 45% band. That's exactly what happened to Margaret. That's why her balance was so painfully wrong. But here's the part nobody tells you. That money's not lost, not even close. You can claim it back, and you can do it quickly. There are 3 simple forms, and the one you need depends on your situation. If you've taken some money out but left the rest in your pension pot, you use a form called P55. If you've emptied the whole pot and you have no other income coming in, you use P50Z. And if you've emptied it but you do have other income, like a state pension or rental income, you use 53Z. All 3 can be done online through your personal tax account. And in most cases, the refund lands in your bank within a few weeks. Just to give you a sense of how huge this problem is, HMRC has already handed back well over £1 billion to overtaxed pensioners. And the average refund recently has been more than £3,000. £3,000. That's not spare change. That's a holiday. That's a car repair. That's peace of mind. So if you ever take a lump sum and the tax looks brutal, please do not assume it's correct. Check it, claim it back, and do it fast. Now, before I move to the second one, let me give you a quick moment. If you're finding this useful so far, and I really hope you are, would you do one small thing for me? Just drop a comment below with the word clarity, because that's exactly what this channel is here to give you. Simple, honest clarity about the money decisions no one else wants to explain. That single word tells YouTube this video matters, and it helps me reach the next retiree who has no idea what's coming. All right, back to the list. The second thing, HMRC quietly expects you to understand flows directly from the first. It's one of the most expensive mistakes a retiree can make without ever knowing they made it. It's called the money purchase annual allowance. Let me explain it in plain language. While you're still working, you're allowed to pay quite a lot into a pension each year and get tax relief on it. For most people, that's up to £60,000 a year. It's generous, it's flexible, it rewards saving. But the very moment you take any taxable income out of a defined contribution pension, that generous allowance collapses. It drops from £60,000 a year all the way down to just £10,000 a year. And here's the cruel part. It stays that way permanently, for the rest of your life, forever. Now think about what that means. Imagine you retire, take a small taxable withdrawal to get through a tough month. Then, a year later, someone offers you a lovely part-time role that you genuinely enjoy. You want to pay some of that new income back into your pension to keep growing your savings. You can't. Not properly. Because without knowing it, you triggered a rule that capped you at £10,000 a year for life. So if there's even a small chance you might return to work in some form, please think very carefully before you touch that first taxable slice. Once it's done, it can't be undone. Now let's clear up the third one, because I hear this misunderstanding all the time. There are no forced pension withdrawals in the UK. None. Zero. If you watch American retirement videos, you'll hear scary talk about being forced to start draining your pension at a certain age. That's not how it works here. In the UK, there is no age at which HMRC forces you to start taking your pension. You can leave a private pension completely untouched for as long as you want. And under current rules, that can actually be one of the smartest things you can do, especially because of how pensions are treated when you pass away. But here's the real trap that replaces the imaginary one. In the UK, the danger isn't being forced to take too little. It's accidentally taking too much in one tax year, because every pound you draw from your pension counts as your total income for that year. Take one big lump sum, and you can push yourself out of the basic rate of tax and straight into the 40% band. The fix is simple, and it's completely legal. Just spread larger withdrawals across 2 or more tax years where possible. Nobody is forcing your hand on timing, which means the timing belongs to you. And when you use it wisely, you keep thousands of pounds you would otherwise hand straight to HMRC. The fourth one sounds obvious, but it's one of the most common mistakes I see. Tell every one of your pension providers that you've officially retired, and make absolutely sure one of them has the correct tax code. This matters more than people realize, especially if you have more than one pension. Here's why. Your state pension is paid to you gross. That means no tax is taken off it before it arrives. HMRC collects whatever tax is due on that state pension by adjusting the code on one of your other pensions instead. So if you have a workplace pension and a state pension, your workplace pension is usually doing the heavy lifting, collecting the tax for both. If the providers don't have the full picture or your code is wrong, one of two things happens. Either you quietly underpay tax all year and get a nasty bill later, or you overpay all year and lose access to money that should have been yours. Neither is fun, so when you retire, make sure every provider knows your situation. Make sure your personal allowance is properly applied. Set it up correctly at the start, and you save yourself a mountain of stress later. Now, the fifth one is more about habit than tax, but it's just as important. When a letter from HMRC arrives, open it that day, not tomorrow. Not when I get around to it, that day. Here's why this matters more in retirement than it ever did during your working life. When you were employed, HMRC almost never wrote to you because everything was handled through your employer. Many people reach retirement having genuinely never received a letter from the taxman in their entire life. So when one finally arrives, it feels frightening, and the instinct is to hide it in a drawer and deal with it later. Please don't. Once your income stops coming through a single employer, HMRC may send you what's called a simple assessment or P800 tax calculation. These letters have deadlines, and HMRC cares far more about the date than about your reasons for missing it. A letter left unopened doesn't quietly disappear. It grows into a bigger bill with a harsher deadline and sometimes a penalty on top. So make it a rule. Every letter open the same day. Before I move to the sixth one, take a breath. I know this is a lot, but I want to say something honestly. If you've been quietly worried about retirement, this video is exactly for you. So if you haven't already, pause for 1 second, hit that share button, and send this to just one person who deserves to know the truth. Not for me, for them. All right, let's keep going. The sixth thing HMRC expects you to know only applies to some people. If you have income that doesn't come through a pension, like rental income, freelance work, or self-employed earnings, you may be pulled into something called self-assessment. Most pensioners never touch this, so if it doesn't apply to you, feel free to relax. But if it does, Listen carefully because there's a nasty first-year surprise that catches people out every single January. Self-assessment has 2 key deadlines, the 31st of January and the 31st of July. But in your very first year, HMRC can ask you to do something that feels almost unfair. They'll ask you to pay the tax you owe for the year that just ended, and on top of that, pay half of next year's estimated tax in advance. It's called payments on account. So your first self-assessment bill can be dramatically bigger than you expected. Because you're effectively paying a year and a half of tax at once. It's not a mistake. It's not a penalty. It's just how the system works. But if nobody warns you, it can hit like a punch in the stomach. So if you know you're heading into self-assessment, put aside more than you think you'll need. Give yourself a cushion. Your future self will thank you. The 7th one might be the most important mindset shift on this entire list. Don't wait around for HMRC to sort out money they owe you. Go and claim it yourself. This is the difference between passive and active, and it's worth real money. Think back to Margaret. She could fill in the correct refund form and get her overpaid tax back within a few weeks. Or she could do nothing and wait for HMRC to eventually reconcile her records at the end of the tax year, which, depending on timing, could mean waiting almost a full year to see her own money again. Same refund, wildly different timing. Yes, the system will eventually correct most overpayments on its own. But eventually can be an incredibly long time when the money in question is yours, and it's sitting in HMRC's account. So whenever you suspect you've been overtaxed on a pension withdrawal, be the one who acts. Fill in the form. Make the phone call. The 8th thing is small, but it's the kind of small habit that saves people thousands over the years. Every April, when the new tax year begins, check your tax code. Don't assume it's right just because it was right last year. Your tax code tells your pension provider how much of your income should be left untaxed. Codes carry forward from one year to the next, and they go wrong far more often than people realize, especially after retirement. If your code is wrong, you're either quietly underpaying and storing up a future bill, or overpaying and giving an interest-free loan. Neither is acceptable. So every April, spend just 5 minutes checking your code in your personal tax account online. If the number looks strange, call HMRC and ask them to explain it. It's a 5-minute habit that catches expensive mistakes. The 9th one is pure housekeeping, but it protects everything else on this list. Keep your details up to date with HMRC and every single pension provider you have. If you moved house when you retired, then HMRC and your old pension schemes might still be writing to your old address. A letter you never receive is a deadline you never knew about. That's how good, honest people end up owing penalties. So make sure your address is up to date everywhere. Make sure each pension provider knows about the others. Getting your allowances and tax code correct depends on someone having the full picture. Inform them all. And finally, the 10th thing on this list. This one is about prevention instead of correction. Use your ISA allowance to keep as much of your future income as possible completely out of the taxman's reach. Everything we've talked about involves HMRC taxing your income. But an ISA is the government-approved way to place money somewhere safe. You can put up to £20,000 a year into ISAs. Any interest, dividends, or growth inside is completely tax-free. It doesn't count as income. It doesn't fill up your personal allowance. It doesn't push you into a higher bracket. Your state pension alone now uses up nearly your entire tax-free personal allowance, meaning other income on top can be taxed. But money kept inside an ISA sits outside all of that. Moving what you can into an ISA protects that money for life. So let me bring all 10 together gently one final time so it sits in your memory. 1, watch out for emergency tax. Claim it back using the right form. 2, understand the money purchase annual allowance because it can slash future contributions forever. 3, no one forces you to draw your pension in the UK, so spread big withdrawals across tax years. 4, tell every provider you've retired and make sure your tax code is correctly set up from day one. 5, open every letter from HMRC the day it arrives, no exceptions. 6, prepare for larger first-year self-assessment bills. 7, claim back overpaid tax yourself. Don't wait a year for the system to notice. 8, check your tax code every April. 9, keep your address and personal details up to date everywhere. And 10, use your ISA allowance every year. 10 simple things, 10 quiet expectations, 10 silent traps that HMRC never bothers to warn you about. Hardly anyone knows a single one of them on the day their working life ends. Every one you miss can cost you money. Now before I go, I need to say something honestly. I've spent years researching the tax world to share it in plain language, but I'm not your personal financial advisor, and nothing I've said today is personal advice for your exact situation. Everyone's circumstances are different, and good tailored advice genuinely pays for itself many times over. The good news is that there's help available that costs you absolutely nothing. The government's free service, PensionWise, is there for you. They will walk you through your pension options in detail. It's especially worth using before you take your first withdrawal. And Citizens Advice can help you with the practical side. Please use them. They exist for exactly this reason. Retirement is supposed to be the reward. It's supposed to be the calm after decades of hard work. It's supposed to be slow mornings, long walks, time with the people you love, and the quiet peace of knowing you're free. But too many people spend the first year of retirement panicking about letters they don't understand and money that disappeared. It doesn't have to be that way. You now know the 10 things HMRC quietly expects you to know. You know what to check. You know what to claim. You know what to avoid. You know what to protect. And that knowledge, more than any pension pot, is what turns retirement from a source of fear into a source of freedom. So if this video helped you even a little, do one final thing for me. Send it to one person you love who is retiring. A few minutes could save them thousands of pounds, spare them a stressful morning, and give them back the peaceful retirement they earned. That's the real gift here. The gift is knowing. And now you know. Look after yourselves. Look after each other. I'll see you in the next one.